Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron try to address the question, how do I know if I'm doing well? From an investment perspective, this has historically meant comparing the performance of an investment strategy to a benchmark. But for meeting life goals, tracking net worth, savings, and spending may be more impactful. And outside of finance, how does your behavior react to what you monitor and track? And now, on to our conversation. Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hi, Aaron. Great to be here today, and thanks everybody for listening.
Great to be here as well. So last week we were talking about kind of prioritizing life over jobs and some of the transitions that people are making. And after our conversation, Trishul kind of asked us, like, how do you know you're doing well? And he kind of meant it in the context of lifestyle, but when he asked that, just being financial advisors and any kind of old-fashioned financial planning or investment management education, the answer for a long time is, well, you compare how you're doing to a benchmark. And so if your performance is doing better than your benchmark, then you're doing well. And if your performance is below a benchmark, then you're not doing well. And it was really interesting. Like that's a good, almost like easily defined answer that is both completely correct and probably completely wrong at the same time. And so we wanted to kind of talk about this of like, how do you know you're doing well? What should you be tracking? And kind of going from like just history of financial services, why that was the case in the past, and maybe we'll get to why it may not be the case in the future, although we can't actually stop ignoring it. So Trishul, do you mind starting us off with kind of history of active management and going back several decades, just the concept of comparing an investment or a portfolio to a benchmark, how it progressed, and then a little bit where we are now.
Yeah, sure thing, Aaron. So essentially, if you step back, way to the beginning, we had stocks that started trading. Initially, these were just companies that were private, and then the first exchanges kind of popped up in the US like 100 years ago or so. And people wanted to invest in these types of stocks. And typically, what they would do is they would hire a broker or they would interact with a broker. That would be like an intermediary who might also give recommendations on what kind of the next best thing is. And so, over time, what also started to happen is a kind of partnership model started to form where you had investors with money tied up with professional money managers. And you can kind of see this evolving. We've talked about this in length of how that industry has kind of grown and evolved in terms of different financial services and different products that have been created along the way. One of the key ones are the mutual funds, which we talked about, started, close to the early part of the last century, the early 1900s-ish. And at that point, what you had is a pooled vehicle of assets where you gather money from a bunch of people and then you take that money as a pool and then you invest that in different securities. And the goal there, of course, is to pick the ones that were more undervalued and the ones that were more likely to go up than others. And, some part of that theory is you want to pick companies that are either cheap or showing some sort of good qualities and so on. Again, we've kind of talked about that at length, but the high level notion there is you're trying to do better than you would by either not doing anything or kind of investing in something else like, real estate or bonds or whatever was available at that time. But then, over time, the notions started to come up where these indices started to show up, where you started looking at a basket of stocks that represented the entire economy. This kind of started with the Dow Jones, I believe. And we could probably add that in the footnotes, but it's one of the earlier indices where they said, okay, what's the sample of these very large companies if we just started tracking them and using that as a gauge or a barometer of how well everything is going overall. So
Yeah, I did a quick search. Looks like the Dow Jones was created in 1896. It was
okay,
about
so
12. It was 12 companies at the time.
right, so the Dow 12, and at that point, what you're kind of thinking is, okay, you have these 12 companies, and then you have the opportunity to invest in one, two, three, four, five, all the way up to 12. And you can also take the amount of money you invest and kind of split it equally or kind of whichever way you want. And once these indices started to show up and they started to be tracked, well, then you had something to compare against. And what we started to learn over longer periods of time is that these indices were a good measure of how the overall economy is doing if they had a representative sample of the companies that made up the economy. That's kind of what the Dow tried to do.
So, just for a little fun,
Yep.
do you think you can name one of those 12 companies?
That's still I don't know, GE.
Yes, yes. General Electric is one of the 12 companies.
Okay.
I think it's the only one that still exists.
Right.
The other ones were American Cotton Oil, American Sugar, American Tobacco, Chicago Gas, Distilling and Cattle Feeding. That's a great company name. General Electric, Lacklead Gas, National Lead, probably. North American. I have no idea what that is. That's just the name of the company is North American. Tennessee Coal and Iron, U.S. Leather, and United States Rubber. But
Okay,
you got it. General Electric. You are on fire today.
I had no chance with the others, to be honest. So that's pretty much luck right there. Well, okay, so over time, more companies started to pop up and so on, and we have some notion of what the Standard and Poor's would represent. A larger subset of companies that probably came later, and there's some back data that can get us even around the early 1900s, but it originally started with 100 companies. So now you had a larger sample, and this kind of represents again more granularly on what's going on with the overall economy, potentially, but certainly what's going on with the overall market economy, the public companies in the US. And, this kind of went on for a long time where you had these indices that kind of tracked these overall things, and you had different indices started popping up to track different groups of companies, either by industry or by size, or even across different asset classes like stocks, bonds, and so on. But one of the novel things to understand is you still had managers who were saying, okay, within that index, let me try to pick a subset that will do better than that index. And that's pretty much how it was for a good amount of time.
It's like,
And
why do I want to pick all the companies when I can, at the very least, exclude the really bad companies?
right, it's one of those things where, yeah, why would you want everything? There have to be companies that are better than others, and why not just pick the ones that are better? Forget those ones that we know are bad, and that's what active management was kind of about. But what started happening is, this is probably where academia came in and started realizing, hey, that index performance isn't so bad. And then a light bulb went off. I guess that this was with Jack Bogle. The first index fund was created, where his notion was, hey, let's just invest in all 500 stocks of the S&P 500. Let's not be too fancy here. Let's see what happens if we just do this, and we can do it for a lot cheaper because we don't need to hire a fancy team of managers to figure out which stocks are better. There's no fanciness required. In fact, it's just a formula, and we can look it up. We know what to do. That's all we got to do. And that's where the first index fund was kind of launched. I don't have the year on that. but is
Looks
that the
like it's
70s?
1976.
Okay, there we go. So, the notion there is now we can invest in the whole in market. And the way the S&P 500 is the 500 largest companies, and they're each in there with a representative share of how large that company is as a percent of the overall pie. So the largest company will have the largest percentage, and the smallest company of that 500 will get a small sliver. But that's basically market cap weighted. It's weighted by the market capitalization of each company, so that overall you get the entire market cap of the S&P 500 equally distributed across the 500 companies based upon how big they are. And as it turns out, that seems like a pretty interesting way to go about investing. This is in the 70s, so we're talking, almost 40, 50 years now. And it's something that could be done. And what's kind of happened, from then until now is there's been a pretty strong transition from the active management type of folks, either individuals who like to manage their own stock portfolios with some insight from their broker, or these mutual funds that were collecting pools of money from individuals and then trying to pick the best stocks, versus these passive notions where you just kind of invest in everything depending on which kind of index you're trying to follow. And there's indices for anything. So there's indices for small stocks, big stocks, growth stocks, value stocks, high yield bonds, low yield bonds, international bonds. So any which way you want to slice it, there's an index for it. And you can either try to beat that index with an active strategy, or you can just match it these days with just a passive strategy. And as I was saying, over the past 50 years, the amount of capital invested in the passive strategies has gone up quite a bit, and the amount that has been driven towards the active strategies has gone down. I think what we've kind of seen over the last decade or two is we're hitting this kind of tipping point where more money has been flowing into the passive than the active, such that I think, probably last year or a few years ago, or maybe even very soon this year, we're going to see more capital invested in these passive notions than the active notions. And my personal opinion is it's probably not going to change or shift to the other direction ever again.
Okay, so if we have seen this transition from active to passive, and I think it's kind of in big part because of this tracking idea of like we compare your performance to a benchmark, but in especially the 80s and 90s, so even though the Vanguard mutual fund already existed, they were still tracking kind of some kind of active performance to some kind of benchmark. And I know a part of this was, well, maybe even if we kind of can try to get a little bit better on the active managed side, or maybe like there's still some managers outperforming. And it's especially, again, it's like pre-internet, so it's kind of harder to get really good data, and computers just weren't quite as strong. But what about when it comes to things like asset allocation? It's like, well, I can beat the S&P 500 because I have small cap and emerging markets in my portfolio, and those have a higher risk return adjustment. So like, one, what is kind of like, how did you incorporate that tracking and benchmarking with a diversified asset allocation portfolio, moving beyond just the active versus passive idea?
Yeah, so this goes back to the fundamental question of, let's say you have a portfolio, and I personally think a good thing to understand is, let's say you're investing in stocks. How are you doing? Like, are you doing well, bad, left, right? Like, well, that's a good question. And, just being up is probably not a good way to measure performance, because stocks go up on their own over time in general. That's how they're designed to work. That's the return you would expect for putting your money to work. So, a good question is, if you're investing in stocks, how are you doing? And how do you answer that question of if you're doing well or not?
So I guess, can you go a little more deeper? Like what did a benchmark for let's just right now, let's go in an all equity portfolio. What would be a good benchmark, and like how do you even have that conversation with clients?
Right. So, the first step in answering the how are you doing question when it comes to investments is you got to figure out what are you trying to do? What's your goal? And there's two ways to think about goals. One is you just want to get more money. You have this absolute goal of you want to be up, 7% a year every year forever. We would call that an absolute return. So it's not relative to anything else, just on its own, you want 7% a year. That's a goal. And the other type of goal is a relative goal, meaning how are you doing compared to some sort of base case? It's like any scientific experiment, you need a control. You need a case that you could do, based upon not having to do anything special. And the control in the markets is a benchmark. And the benchmark is decided upon based upon what your investment goal is. So, for example, if your investment goal is to save money for retirement and you happen to be comfortable taking a lot of risk, then yeah, 100% equity allocation or a benchmark that represents 100% equity allocation would likely be your goal. But if you're, more conservative, it might be a lower allocation to equities. A conservative investor might say, no, I want to try to be a 70% equity and a 30% bond portfolio over this investment horizon of 20, 30 years. And now that's perfectly fine. But the key thing is you should probably decide on your control before you start the experiment. That's how experiments are usually run, right? You don't want to just start investing and say, hey, I beat that thing over there, but you were really, trying to beat something else, or you had no idea what you're really trying to beat to begin with. Because then it becomes really tricky to gauge performance. There's a lot of biases that kind of creep in. If you wait a couple years and then you start looking at, how you did without deciding beforehand what you're trying to do, then it's easy to kind of convince yourself by saying, hey, look, I'm up 7%. And, this other thing, this 30% bond portfolio was up, 2% annualized. But, was that really your control, or is that what you happen to be looking at now to kind of make yourself feel better?
So you could see something like, I'm up 8% and outperformed your 60/40 portfolio which only did 5%. And then in a down market, I'm down 25%, but the S&P 500 is down 40. So, I mean, you're getting the best of both worlds.
Right. Yeah. So it's very important to make these decisions ahead of time if you want to kind of be fair to the results, because you can always change the benchmark after the fact to find a benchmark that you beat and convince yourself that that's what you were trying to do all along.
Okay. So I guess one of the things let's say, here's an example. You're helping a client choose the options in their 401k, and they send you the list of options. For this conversation, let's say they happen to be mutual funds that we actually have data, excluding like commingled and pooled funds that are unique to that particular 401k, that they just won't share the data with anyone outside. But mutual funds have good public data. When you look at these list of funds, and let's say there are no passive options, okay? Because you just kind of default to that. But none of the fees are outrageous, okay? They're all going to be, say, between 40 and 70 basis points, okay? how would you start to choose which of those funds to put together an asset allocation?
Right. So
There's no target date funds, no passive funds. You have to choose. But we do have kind of performance and asset class and um what you and no, they're all the same fees. So yeah, we have performance and asset class kind of thing.
right. So a few things. First, the reason I'm going for the passive funds, if possible, to begin with, is I personally feel they're the better choice. And I think there's a good amount of research to back that up. And the reason I say this is because if you look at the performance of active funds versus passive funds, if you look at the average performance, the passive funds actually end up doing better once you account for all the fees involved and the extra tax implications of the active funds. So the active funds are going to charge a much higher fee, about 9 to 10 times higher. It is not uncommon. And that can add up over time and degrade performance if you're not getting anything extra. And the evidence suggests that it's unlikely in the average case that you're going to get something extra. And some of the research that I've mentioned way back and across a couple episodes, and I've written articles about this and whatnot, is that maybe there was a chance that these active funds did better. There's some research that suggests, like in the 90s, that they were providing some benefit, meaning there were statistically significant numbers of these types of active funds that outperformed. Maybe like 15 to 20% of them outperformed in the 90s. But if you rerun that analysis, the study that I'm mentioning, I'll put in the show notes. We ran that analysis in the year 2000s, and that number dropped close to zero, meaning there were almost no active funds that did better than statistics would suggest should do better, meaning some have to do better just because somebody has to win at the casino. But if more than that number win at the casino, then something's wrong with the casino.
So I
And
guess I think that's why I'm trying to put these. So when I think of history, so for example, I had to look this up, but do you happen to know when the MSCI World Index, I think it might be called MSCI All Country World Index now, but the MSCI World Index was created?
I don't know, because they actually stitched data as well to kind of have it go back even further. So you might be looking at data that goes before the MSCI World actually came out, because it's using historical data to tie things together.
Okay, so do you have a guess?
If I had to guess on the MSCI World, I don't know, 20 years ago.
Okay, see, that actually would have been my guess too. I never really heard of it until like late 90s, early 2000s. And like when it be, and especially like 2000, late 2000 aughts, late aughts, uh, where we're now actually starting to incorporate international and emerging markets, especially after the tech bubble, which was mostly US. So I thought it was about the same time too. That's kind of when it, I don't want to say came in vogue, but at least more people started looking at it. It's actually been around since 1969. So it's actually was around before Jack Bogle created the Vanguard Group and created the first index mutual fund in 1976. And I think the reason I asked that question is trying to kind of not criticize predecessors, criticize advisors in the late 90s, early 2000s who didn't use passive because maybe the research wasn't quite there yet, it wasn't in vogue. Like it would have been seen as weird, almost like or like true like counterculture kind of thing, that you're going against the grain. And so I'm curious. That's why I try to create this constraint. If you got a client with a 401k, they only have active managed funds, and there's no passive option, no target date option. How would you put together an asset allocation? This would be similar to what advisors did 20 years ago, where they weren't necessarily considering passive options, weren't considering ETFs, but they had some idea that they're like lower, that kind of fees mattered. They had some idea that asset allocation makes a big difference. They have some access to an all country world index and market cap weighting, but they like you're trying to put together an allocation of large cap, small cap, international, developed, emerging markets in this 401k. What would you look at, or what did you look at 20 years ago?
Right. Yeah. So basically, now that I've made a case on why I'm going for passive, it's essentially because there's research that suggests that the passive is probably going to leave you in a better spot because of their lower fees and the better chance of matching the index rather than underperforming because of those higher fees trying to beat it. And from that perspective, what I'd first look at is the fees and, kind of sort the rankings by that in terms of the options available in the 401k plan. That would kind of give me some insight. And probably the next metric I would look at is the tracking error. So that's a
Okay.
statistical measure of how close a actively managed portfolio is to the benchmark. And I would look for strategies that try to minimize that tracking error. I mean, they're trying to track it pretty closely. And that in my mind means that the advisor or the manager of that mutual fund is not trying to do anything too fancy, because my personal belief is that trying to get too fancy will not likely lead to better results.
Okay, so here's kind of that was the answer I was really hoping for, because I was trying to set you up for that. And here's the challenge I've seen. This is like almost like bringing in just psychology for every single person. When you look at those 401k options, they list their results 1 year, 3 year, 5 year, 10 year, or since inception, something like that. You can see the performance of each of these funds. If you look up and see the small cap value index was plus 11% last year, and it's kind of averaged, say, 9% over the last 3, 5, 10 years. You have two fund options, okay? The fund option that happens to cost, say, 50 basis points tracks those numbers pretty well. The one that costs, say, 45 basis points actually did a plus 17% in the last year. So it is slightly cheaper, just barely. Has that plus 17% has kind of driven up all of the past historical returns. Okay, so now that since inception number is 0.5% better. It's 9.6 instead of 9.1. And the 3 and 5 year numbers are also 0.5% better. But the last year was up 17, where the other one was up 11, and the index was up 11. Describe to me how you feel and how you look at that, and which one you would choose for the small cap value allocation of this 401k.
Right. The one mantra I would want to repeat as I'm looking through these performance data is past performance does not, indicate future returns. And what we really need to try to do is not let that great year of that cheaper fund, add too much weight in our analysis. In fact, I would probably give it a 0 weight. And I do that for a handful of reasons. But essentially, I would rather go with the one that's slightly more expensive, 5 basis points difference. That's almost nothing, frankly, in my mind, over many long periods of time. And for that, I'm more likely to hug that benchmark with the second option, even though it's slightly more expensive. And the reason why that first option, that's 45 basis points, but had that stellar, one period over that long history, is because there's so many things a professional manager or a professional management firm can do that are not ideal for the end investor that raise concern for me. For example, there's this notion that if you're a mutual fund company, one thing you would probably want to do is make 15 or 20 different mutual funds that track the same benchmark, and then after a couple years you have a good track record for two or three. One of them is your Mr. 45 basis points but had a good year fund, and you put that out there, right? And is there any evidence to say that that particular manager or that particular fund out of the 20 that mutual fund company started is actually better than any of the other 19? Or did it just happen to do well? Because if you have, 20 monkeys throwing darts and one of them happens to do well, meaning picks a handful of stocks that do okay, then that's what you're probably going to see with the numbers. And that's what you might be seeing with that one manager or that one fund that's slightly cheaper but did better in 1 year.
I think you and I are like really vibing right now, because that's exactly kind of what I was hoping you would say. That this past performance, it's that tracking error, it's you give a zero weight to that 1 year. But it's acknowledging that every person who looks at that page is going to choose the 17%. If they're not in the financial services industry, if they're just an employee, regular employee at this company, they're like, oh, this one did better, it must be better. It's such a human default to look at these numbers and just choose the one. Oh, it's even got that lower fee. It's lower by 5 basis points, but it's lower. It's lower, had better performance, must be better. And it's so hard to overcome that default instinctual response. And when I'm looking at these funds, especially because if I have mutual funds, I'll actually pull up Morningstar, because Morningstar has good public free data that you can see just kind of how it tracks its own chosen benchmark. That's kind of like, so each mutual fund, like they have their own benchmark that they list and they track, and Morningstar has that data of like, how does it do versus its own benchmark? How does it do versus category, which is like a Morningstar definition? How does it do versus, I think there's one other tracking that Morningstar provides. I can't remember off the top of my head, but it's acknowledging that every person not working with an advisor, every person not in our industry, when they look at those two, they're going to choose the 17% one. And it's so hard to resist that. Like, you and I can almost like take it for granted. And the reason I kind of talk about that is, if we see the data, like we actually have performance versus benchmark, we have this data of like, yes, it outperformed, and we're actually telling you to ignore that. I think that's one of the things I think about. And for me, all my client conversations are about their lives of financial planning. The performance actually doesn't even come up. Now, again, they have quarterly statements and they can look it up. I look it up occasionally, like, just, is the asset allocation we're looking at doing in line with what we're expecting? If U.S. stocks are up 4% over the last few months and international stocks are flat, does the asset allocation look like that? But it's trying to think about, like, even if we have good data, we have good performance numbers, good benchmark numbers, they've chosen the benchmark, and there's outperformance, there's still so often that we're almost ignoring that for one reason or another. And so now I'm curious, when you talk to clients, one, do you talk about performance? Do you talk about benchmarks? Do you talk about any kind of tracking? Maybe like, do you have like a beta conversation? Like, it would not surprise me if that particular small cap fund outperformed just because it took on more risk. and we're not necessarily looking to take on more risk. Could be we're having that 60-40 conversation, like you said, that equity to bond performance. Yes, we purposely want to underperform the S&P 500 because we're in a 60-40 portfolio. Like, we don't want to take on that much risk. So I'm curious now, when you are talking about investments, and not for new clients, but for existing clients who have been investing with you, what are some of those conversations like?
Right. So I think, for me, it's about finding a good fit, with to become a new client. For example, I want to be upfront with whoever invests with me. I'm not going to be that manager who's trying to swing for the fences or come up with the new crazy idea, or, here's what the buzz on the street and here's why you need to get in now. That's not going to be me. And the principles I try to lay out early on is that I want to encourage a certain philosophy that I believe in, and one of the cornerstones of that philosophy is thinking passively, not trying to beat the market but trying to match it. And to tie into that, I pull in the notions of thinking long term, because the more time you have in the market, the more chance that the market will work for you. It's that notion of, it's not about timing the market, it's about your time in the market. I also like to put forward the notion of allocating globally. It's not just about the US. US doesn't have a monopoly on actual performance of their stocks, because if the performance, not the performance of the economy, that may have a slight edge over other economies, may, air quotes. But if the stock market had an edge over all other stock markets, well, that wouldn't make sense, because if everybody said, hey, the US always does better, then people would buy up the US, so that that efficiency should go away pretty quickly. So, investing globally is where I try to transition the conversations, and keeping those risks in balance based upon a given client's preferences, based upon their willingness and their need and their ability to take on risk. So that's where I try to keep the conversation. So, the first kind of screener is, again, not trying to beat the market here, trying to match it. And that might be a big differentiator. And once we kind of get past that, it's more, when it comes to the investment side of things, yeah, it's more about how are we doing across these other objectives. Are we still continuing to, be passive, and how is our global positions doing, and are the risks in line with preferences, and do we still have this long-term focus? And again, I also like to have these conversations before the market crashes, because we want to make sure that we're comfortable with the risk before the house is on fire, right? That's when we want to review the insurance policy.
Yeah, that's a good point. So look at, okay, I'm your client. I've bought in. Okay, I wasn't even a skeptical person. I just didn't know what to do, and I appreciate your advice. Well, thank you, Trishul, so much. I am confident we're invested well. We've been doing this for a couple years. I have my Zoom meeting with you. I ask, how am I doing?
Right. Yeah. So, frankly, a good part of the conversation is more about how that client is doing in relation to their life goals, to be, quite frank. And that pretty much dominates the conversation, meaning, first thing, what's new? What's changed? Since, we last spoke? And then, having a good update on, what's going on with the financial situation, and, what's the finances look like for this individual. For example, Aaron, how's your net worth? How's it changed since we last spoke? And how is your balance sheet? Have you been able to, pay down that debt? And yes, your investments are growing. That'll be part of the conversation. But what I like to also hedge it with is, hey, your investments are growing. It seems to be in line with what we would expect. And what I've been saying lately, for example, just some behavioral coaching is, the last year or so, frankly, has been very calm, and markets have done quite well, and things will get more hectic and bouncy. And do not expect the markets to be this complacent and happy in the long term. This is basically a period where things are a lot less volatile than we should expect going forward.
That's a great point. So I also look at net worth, kind of both, because there's the main functions of increasing net worth are investment growth, which is out of your control. It's based on the asset allocation we chose, time frame, risk tolerance, but it's out of our control. The other two components, paying down debt, reducing liabilities, and adding to your assets, saving and investing, additions to accounts, contributions to retirement plans, those are things within your control. And so when I sit down with a client, if they're asking kind of, how am I doing? It's usually like, you're doing great. You maxed out your 401k, and we're saving this much each month into our taxable investment account. And like you've told me that this fits in your cash flow, and you're ready so that when you get that next raise, we're going to increase the savings, and we're going to make sure at the beginning of each year that you're on track to max out your 401k, because the IRS does make changes to those max contribution numbers each year. And it's almost entirely focused on the things that they control, that are in their control, and acknowledging that the investment returns, while they might end up being a big driver of their net worth growth, depending on the stage of life, how much they've grown their net worth to start with, and what the rate of return from just market returns were. So over the last couple of years, market returns have been a big driver of net worth growth. But I acknowledge that wasn't my control. That like I didn't do anything special to help your net worth grow 20% over the last few years. It was just kind of, that's why we were invested then. We stayed invested. We kind of kept adding to portfolios. For younger clients, it's usually the amount they're saving will increase their portfolios more than investment returns. And there's at some point some transition point for each individual, for each household, but trying to focus on how much are you saving versus how much you're spending in that relationship. That kind of like gets back to like our first questions. Like, that's what I track for clients. It's not performance versus benchmark. Again, that data is there, they can find it, but it's how much are you saving, how much are you spending. And even then, I don't need categorization or itemization of spending. I'll keep track of their mortgage because that gets paid off and it's a flat payment. It's like that's actually an example. Like, if their income goes up slightly just with cost of living adjustments and their mortgage stays flat, are they spending that freed up cash flow, or are they increasing their savings of that freed up cash flow? And most likely it's somewhere in the middle. It's a combination of both. But that's the thing I track. That's the thing we focus on, is how much are you saving and adding to your investment portfolio. And then it's also like, so I actually pull up, like, I like SEI, they have a really good net flows report, because it's actually additions minus withdrawals. So for clients who are retired, pulling money out of the portfolio, it's focusing on withdrawal rate. So for those accumulating, it's additions to the portfolio. For those who are no longer working, focusing on withdrawals and that withdrawal rate, because again, it's another thing within their control. They get to choose how much they take from their portfolio to support the lifestyle that they want. And that's what we're going to track. And how does that affect long-term projections, Monte Carlo simulations, to make sure we're not running out of money? How are we managing a slightly higher withdrawal rates? We're getting up to 5% in the last few years. have done great supporting a 5% withdrawal rate. But I keep telling clients, if we have a down year, and it's not if, but when we have a down year, that 5% withdrawal rate is going to be a little too high. We're going to need to pull it back a little bit. We're going to need to reduce your withdrawal rate in that year. And that's the trade-off. That's the balancing. That's the managing withdrawal rate. That's the conversation they get to decide. That's a risk that they're comfortable with. They'll say, yes, we'd like to take more out of our portfolio these next few years, and when there's a downturn, we're ready to take less from our portfolio. But those net flows, that's like for you mentioned net worth, and mine was really close, because it is really important, but it's also acknowledging what parts were under my control and under their control, and which parts are out of our control. So I'm curious, what else do you either track or discuss in client meetings for ongoing clients?
Well, so there's also a bit of a distinction where, I of course look at the performance of my client portfolios as compared to the benchmark I'm trying to match. That's how I know things are going as they should, and that's something very important to understand. And the way I look at it is from a perspective, something known as the time-weighted return. And the notion here is it's a return that takes into account the things that are outside of my control. The fact that the client, took out 20,000 this quarter and added 50,000 next quarter, that shouldn't be baked into my numbers, right? I have to account for that when I look at the return of just the money I'm managing for the periods I'm managing. And that's what the time-weighted return does. So more specifically, if a client is looking at their statement, you may not see that time-weighted return number. What you may see is the change in the account values. You may see the investments, dollar amount go up because, the stock prices of those instruments increased. But it might be hard to get an actual return number. And here's why. Let's say at the beginning of the account, the statement says you started with 900,000. And at the end of the account, end of the period or quarter, you ended up with $1 million. But along the way, you deposited, $50,000 and, chunks of 10,000 every couple of weeks, something like that. But then at the same time, the investments went up and down. And, that added a certain amount to the return. And it's tricky to say, okay, what's your actual return now? Well, you got to back out that money moving in and out to figure out what your true time-weighted return is. And it's a calculation that can be done. And that's the number you want to use to compare against the benchmark. So, when a client is, maybe looking at how they're doing, I feel it's important that they know that what that time-weighted return is. And frankly, I like to look at that time-weighted return across all the accounts in a client's portfolio, because I run an asset location strategy where I try to put different investments in different accounts depending on their tax status. So that way, each individual portfolio may not make sense when you compare it to the individual's benchmark. But when you tie everything together and you look across all the accounts for a client, and then you get a time-weighted return, and then you compare that with a benchmark, then you get a good sense of what's going on. And hopefully that number is what we would expect. And that's what I go for when I manage, my money. And that's what I like to communicate if a client wants to go in that direction. That's what I'm looking at. The time-weighted return across all the accounts. And frankly, I feel like that time-weighted return notion, it's hard to do from a few perspectives. Again, it's not on the statements. And a lot of the brokers, it's often, in the past, they didn't even like showing it for some reason. It's like probably the most important thing, but you see a billion numbers except for that. You'll see certainly, the change in positions and stuff like that, but you may not see the actual return. And if you have many accounts, it's very hard to see. You got to tie all this together. So to see how the actual performance is doing, that's something that is important to me as my job as the manager. And yeah, if it comes up with a client, I definitely like to walk through that with them so they understand, the big picture.
Yeah, that's actually one of the things that I happen to like about SEI's reports. They used to have it on their paper statements, but they've moved a lot of their good data to online to try and encourage paperless. Is a market value versus net investment chart, and it just shows those two lines over time. And for a long time, the kind of you'll see market value tracks net investment more than kind of performance numbers. Like those correlate for most of your life until you get to say 50s, 60s. Like you're within say 5 to 10 years of being able to be financially independent. It's like then the market value tends to um, outpace the net investment. And it's also hard to distinguish what this looked like, say, 5 years ago versus what it looks like now, just because markets have done so well over the last few years, that, and especially the last 10. And so that's kind of has driven a lot of that growth. But it's a similar idea. It's like you can see, like the time, I guess I say the time weighted return is more accurate, but it's a little harder to get that data, and it's a little harder for a client to interpret it. That graph of market value versus net investment is a really good visual that I like. That reminds them, yes, your market value is up. You can see I have a client that has gone from like 700,000 to 1.4 million over the last 6 years ish, but about half of that was their own savings. Was just them contributing each year to retirement accounts, and like that's the big driver. And so that now they see like, oh, we could see that they see the account value number, but it's recognizing how much was in their control and how much is just we also happen to have a bull market. So is there with thinking about this idea and a little bit like we talked about last time of like there's this like idea like whatever you track is what you manage towards. It's like what you kind of I'll say optimize or maximize was like whatever you track is the thing you pay attention to, which is kind of like by definition, whatever you track is the thing you're paying attention to. But for a long time, just in investment management, because performance was the thing that was being tracked, that's what everyone focused on. And now we've kind of come to this era where acknowledging passive investments may be superior, or at the very least, kind of understanding market returns outside your control versus savings and withdrawals that are inside your control. Are there any other things that you track, whether it's either financial or non-financial, that you've noticed either for yourself or for your clients that you do that more because you're tracking it?
Right. So part of the financial planning process, it's a multi-step process, but initially the idea is you come up with a bunch of goals. And those goals are short, medium, long term, saving up for kids' college, medium term, retirement, long term, short term, buying a house. And each of those have a certain kind of progress meter associated with them, right? You can kind of think of a gauge going from like 0 to 100%. And over time, the idea is you want to have money coming in and going into those buckets. And then once they're in those buckets, they're invested sensibly based upon the time horizon of those goals. And you combine all that together and you get a certain measure. You can do like simulations to kind of represent what the market may do over the next 10, 20, 30, 40 years. And, these simulations give you an aggregate measure of what is your chance of meeting all of these goals. You know, out of 1,000 different runs of the simulations, 900 are going to meet that objective, these objectives. So that's the Monte Carlo simulation for financial planning, and it's something that we've talked about in other episodes. But yeah, if the notion is, we have a plan and we think that we're making good progress towards it, and if we make these changes, we can increase our confidence in meeting all of these goals from like 50% to 80%. Well, that's something that would provide a good amount of value. And yeah, that's something that I feel is a good thing to track, and that's probably where the conversation would be kind of geared around, because that's where we can do things that are in our control, right? The things that we are able to tune and tweak and adjust, and make sure that things are as sensible as possible. Are we saving as much as we can? Are we taking advantage of all the tax advantages as we can? Do we have a sensible strategy for pulling money out in a tax efficient manner, and so on?
What about is there anything for you on the personal side that you track? Like, so it's like kind of there are people who might track, like, people track steps. It's a great way to increase your health. Like, if you just take more steps, and like you can tell the people who are tracking steps or having their phone or Fitbit track it for them, they take more steps in the day. Other people might track calories. Like, I know that was a little more common in the past. I don't know how viable it is as a dieting strategy, but people who are tracking, say, carbohydrates or fruit or other things like that, they're doing it with their kind of health in mind. Even just tracking your weight, just stepping on the scale is like mentally tracking weight. I know people who've tried to track, like, they the PTA requires a certain number of volunteer hours for the year for certain tax and reporting reasons, compliance reasons. So there are people who track how many hours they volunteer for the PTA. And so because they're tracking it, they try and say, okay, can I do just a little bit more next year? And I know of other people who will try and track days off or track ski days or kind of things like that. I'm just curious, is there anything in your life that you are tracking that you find yourself working towards almost subconsciously?
It's interesting. When I was working, there were certainly lots of metrics and KPIs. Working for an employer. When I had the 9 to 5, there were certainly lots of metrics that we used to track in and out, and I used to know all of these business type statistics. And I've taken a different approach since then, frankly. And my personal life and in my business life. For example, with my business, I don't track key performance indicators. How many calls have I made, or people signed up and whatnot. I kind of just see what happens and try to make things incrementally better. And it seems like it's a less data intensive approach, because I just think, okay, what can I do a little bit better on? And then I have a short list and I just kind of work on that. And it's kind of true, not only with my business, but in my individual life. I don't really get too granular. I remember when I started running, I started tracking. This was my project for 2020, to run a mile without having to stop. I remember we talked about this sometime last year, but I was tracking.
Did you make it? I don't remember.
I did make it. I did make it.
Okay.
And I transitioned from that to trying to work out more, and I never had a key measure or anything like that, but I just realized I should probably be working out more, and I started with 2 days a week, 3 days a week, 4 days a week, and I'm up to like 5 or 6 days a week now. But I don't think I'm tracking any of this. It frankly, to me, it's been lately more about, just what can I do slightly better? And I feel like that snowball effect is enough for what I need to do.
Yeah, part of the reason I asked that is I feel like I've taken a similar perspective as you, where because I don't track that many things, I feel a little less stress in my life. Um, it's like I don't have that like just mental exhaustion. Uh, I have noticed like I will kind of track my my time on the New York Times crossword puzzle. So I do it on the app on my phone. And I have like it'll track your best time for each day of the week. And can I do better than my best time each day of the week? I do a pretty good job of getting most Monday through Thursdays and Sundays done. Don't always get Friday and Saturday done. Sometimes I don't even start those two. But as you were talking about it, I realized one of the things I do track is my pull-ups. There was a stage probably a couple years ago where I actually got up to 11 pull-ups. I could do 11 pull-ups, and it's the best I've ever done in my life. And then I hurt my shoulder, and I needed to do physical therapy. And so that like went all the way back down to like 3. And so I have noticed over the last few months, I've been tracking without thinking about it. I don't have to write it down. Just like, how many pull-ups can I do? And I'm like 6 or 7 now. But yeah, it's one of those things of, I guess it's probably if there was a kind of advice in there somewhere, it's being conscious of the impact of tracking. And so if you want to increase something, you should track that thing. And that's like why all the business advice is if you want to grow your revenue, you track all of these KPIs that lead to revenue growth. But it's more work to track that. Like the results and success follow, but that is more work. Whereas you and I are kind of very conscious, like we almost are specifically choosing not to track. It's like I track my clients really well because I care about them and I want to make sure that I'm always kind of thinking about them. But I don't, for example, track people who have reached out to me in the past and said, you know what, not at this time, maybe in the future. Like they don't ask me to follow up. If they've asked me to follow up, I'll set a calendar reminder, I will. But there's like, no, not right now. Whereas every other like classic sales and business growth strategy would be like putting them on your email list to check in with them every 3 to 6 months so that when they're ready, you're the first person top of mind. And it's just something I just don't do. I have had a couple people who like come back to me a year later and say, okay, now I'm ready. I think it's just part of like my personality, their personality. Like I don't push them at all, but I don't track it. But I do track pull-ups. So
yeah.
And maybe I don't track cookies.
Right. I think there probably was a stage in my life where I tracked tons of things all over the place, but I just feel like I'm in a different place now where I'm just okay with making small changes in the right direction.
Okay. Well, if there's any listeners out there who want to share a story of like what you track in your life that you either consciously or subconsciously have noticed you improve because you're tracking it, I think we'd be really curious hearing those stories.
Yeah, we'd love to hear from you. And I enjoyed the conversation, Aaron. Thanks. And thanks, everybody, for listening. If you're wanting to hear more, do subscribe.
Thanks. Bye.
Thanks.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.